Okay, so in terms of resolving stakeholder conflicts, resolving stakeholder conflict, there are several ways you could do that. There are several ways you could do that. And we'll talk through some of them. So, for example, what we call the agency theory, it is based on the view that your corporate governance system should be designed in the way you structure your organization, or you administer the affairs of your organization. It should be based on the fact that it minimizes the agency problem. So that there's an alignment between management objectives and shareholder objectives. So there's a way you could structure the management remuneration system, or how they are paid, such that they are not always looking at themselves. They're not always looking at themselves, because the more they look at themselves, it doesn't help the organization, or they look at their interest alone. So that's why today a lot of organizations are giving share options, or stock options, to the employees, so that it motivates them to drive the market value of the company. So that's a way you can manage the whole agency conflicting, by designing an effective management remuneration system. But you need to know that, nothing is perfect, so sometimes it might not be able to achieve 100% the intended objective, but at least it gives you a certain, platform, or it gives you a certain way of doing things. Another thing which I needed to talk about in relation to the whole, as we talked about from the beginning, in relation to ethics, was management also must act ethically. They should act ethically, and they should be ethical in the way they deal with customers and everything. And ethics is simply honesty and integrity. That's basically it. There's nothing. And as we realized in the last case, we realized that one of the part owners or co-founders of Lux company, was a lot more into ethics. He was an ethics freak, and he loved to be ethical and do things ethically. So that's a key importance. So in conclusion, you can resolve stakeholder conflicts by, if you have ethical employees, they'll realize that, putting our personal interest above company interest is not necessarily a good idea. Okay, now let's move on to investment decisions. Any questions so far? Investment decisions. Any questions so far? Okay. So investment decisions is what we call CAPEX, or capital expenditure. CAPEX, or capital expenditure. So when we say capital expenditure, we are basically saying that we are spending on non-current assets. And you all know what non-current assets are: fixed assets. So your buildings, your equipment, your land, all these things are capital expenditure. All these are capital expenditure. So we have two types of expenditure, as you all know. We have capital expenditure, you have revenue expenditure. So the revenue expenditure is more, it basically does not create long-term assets. It does not create long-term assets. And it is written off as an expense in the income statement. Capital expenditure goes into the balance sheet. So that's basically the difference. So it creates short-term assets and it goes into the IS or the income statement. Capital expenditure creates long-term assets and goes into the balance sheet. Okay. So you have different kinds of capital expenditure. You have essential capital expenditure. So for example, if you own a transport company and your buses are getting worn out and you need it to run your business, that becomes essential capital expenditure. They also have discretionary, you know. These are like, it's based on your own discretion. So you try to latch on to new business initiatives. Yeah, that's discretionary. You do not necessarily have to do it. It's not essential, but you decided to do it. So it's based on your discretion. Before any capital expenditure project is undertaken, you need to understand that they have to be assessed and evaluated. They have to be assessed and evaluated. What do I mean by this? I mean that they have to be appraised. So this is where the concept of investment appraisal comes in. Investment appraisals comes in. The investment must make sense because capital expenditure is huge. The money, the financial outlay is huge. It has to make sense. It has to make sense. So the investment appraiser will tell you whether, this investment, is it worthwhile? Should it be undertaken or should it not? That is the whole essence of your investment appraisal. Okay, then I should have brought methods of investment appraisal before, but okay, let's talk about capital budgets and then we'll talk about the methods. So we talked about capital expenditure, we talked about investment appraisal. So what is capital budgeting? Because capital budgeting is basically like what you had for a cash budgeting, right? You're budgeting for cash. This one you're budgeting for capital investments. So you want to create an appropriate framework for capital spending. So you have a broad framework or a plan, that sets out, the capital expenditure for, let's say 10 years. So which has to be reviewed and updated, So that's very, very key. That's very, very important. Very, very important. Yeah, so that's it about capital budgeting. And you need to, investment appraisal happens within the context of a capital budget. So anytime you are trying to appraise an investment, you must look at it in line with the company's strategic capital objectives. You must also look at it within the performance of investment projects in the past. And you must also look at the spending criteria of the organization. So these are some, examples, of how your investment appraisal has to be linked to your capital budget. What are some of the methods of investment appraisal? You have ARR, you can call it ROI. You have the payback method, and you have the discounted cash flow methods. Okay. So what is an example? Sorry. What's an example of accounting rate of return? So this is a simple question. A simple question, right? A company is considering a project which requires an investment of 120,000. You see? In machinery, which is capital expenditure. The machinery will last 4 years, after which it will have a scrap value of what? 20,000. 20,000. The investment in additional working capital will be 15,000. The expected annual profits before depreciation are year 1, 45,000, year 2, 45,000, year 3, 40,000, year 4, 25,000. The company requires a minimum accounting rate of return of 15% from projects of this type. ARR is measured as average annual profits as a percentage of the average investment. So it's basically like ROI. Okay, so how do you approach a question like this? How do you approach a question like this? Very, very simple. So first of all, you need to know the profits before depreciation. You need to know the profit. What are the profits? They've given it to you here. They said year 1 is 45, year 2 is 45, year 3 is 40, and year 4 is 25. If you add all the profits, you come to an amount of 155,000. 155,000. Remember, these profits are before depreciation. These profits are before depreciation. So now you need to take out depreciation. But how do you find depreciation? The question didn't seem to give us depreciation. So how do you find depreciation? You find depreciation if you can tell, if they give you the scrap value, you know. So if you know the investment costs and the scrap value, you can tell depreciation. Because it's after you've used an investment over time, you know, that will result in a scrap. It's like you have a car, and the car is 5,000, right? Then you've used this, so 10 years time down the line, they say the car is 500. It's moved from 5,000 to 500. So what's the difference between the 5,000 and the 500? Is the worn out parts, the wear and tear that happened on the car, which is the depreciation. So the depreciation will be 120,000, which is the cost of the investment, minus the scrap value, which is 20,000, which gives you 100,000. So the total project after depreciation, or profit after depreciation, I must say, is 55,000. For how many years? 4. So you divide 55,000 by 4, you should have 13,750. 13,750. Very, very important. Very, very important. I hope you are getting the picture. I hope it's clear. So that's your profit, 13,750. But if you'd realize, your ARR is measured as annual profit divided by the average investment. The average investment. The average investment. So, so how do you calculate the average investment? The average investment is pretty simple. Pretty simple. Hello, can you hear me? Is it my laptop or?
Yes, sir.
Okay. Okay, that's great. Okay, so the average investment is very, very simple. So you need to look at different kinds of you need to look at different kinds of what do you call it? Can you please mute your microphones? I beg you. I beg you, please. Thank you. Can you please mute your microphones if you haven't, please? I beg you, please. Okay, so your average investment will be 120,000 plus 20,000 divided by 2. That will be your average investment. Then you don't forget about your investment in working capital, which is 15,000. So that would give you 85,000. You divide your profits by your average investment, and you should have your accounting rate of return, which in this case was 16.2. Very, very simple. Let's talk about payback. Payback, how long it takes for an investment to pay you back. So this is length of time. How long does it take? How long does it take? Okay. So again, a company requires all investment projects to pay back their initial investment within 3 years. It is considering a new project requiring a capital outlay of 140,000 on plant and equipment and an investment of 20,000 in working capital. The project is expected to earn the following net cash receipts: 40, 50, 90, 25. Should the investment be undertaken? Should the investment be undertaken? What do you think? What do you think? Okay, let me just go through because I'm not sure it can be discussed like that. So, it is considering a new project, right? Requiring a capital outlay of 140,000 and an investment of 20,000 working capital. So that is referring to investment now. So that will be times year 0. You add the two, 140 plus 20, that's 160. It's a cash outflow, so make sure to say negative or put it in brackets, right? So you have 160,000, 40,000, 50,000, 90,000, 20, 45,000 from year 0 to year 4, respectively. Then you need to include a cumulative cash position at the end of the year. You know, the cumulative cash position will take into consideration the impact. So in year 0, there's a cash flow of 160,000. So the cumulative cash position will also be 160,000, negative 160,000, I must say. In year 1, there was a cash flow of 40,000, which is positive, right? So your cumulative cash position will then be negative 160,000 plus 40,000, which will give you negative 120,000. In year 3, there was a cash inflow, a cash benefit of 50,000. So your cumulative cash position will be negative 120,000 plus 50,000, which is minus 70,000. Year 3, cash inflow 90,000. So your cumulative cash position will be negative 70,000 plus 90,000 will give you 20,000 positive. Year 4, cash flow 45,000, right? So your cumulative cash position will be 20 plus 45,000, which is 65,000. So looking at this, you realize that the payback is 3 years. The payback is 3 years because it's at 3 years that we realize that, oh, the cash flows became positive. The cumulative cash flow became positive. The cumulative cash flow became positive. So it's 3 years, and so it meets the criteria, kind of. It's a little below 3 years, but so it meets the criteria, basically. So the investments should be undertaken. Should be undertaken. Okay. Okay, so let's look into, as we are talking about foreign investment appraisal, let's look into this example. This example that combines discounted cash flow, because discounted cash flow and MPV and all that, and brings a foreign dimension to it as well. So let's look at an example like this. A Nigerian company is considering an investment in a project in Ghana. A Nigerian company is considering an investment in a project in Ghana. The current exchange rate for the Ghanaian cedi is 50 naira is equal to 1 cedi. The discount rate for the project in Ghana will be 10%. The discount rate for similar projects in Nigeria is 8%. The project will require an initial investment of 100,000 and lead to cash inflows of 50,000 per annum for the next 3 years. The MPV of the project in Naira can be found as follows. So how do you find MPV basically? You cannot find MPV without discounting. We talked about investment appraisal techniques and we talked about discounted cash flow, DCF analysis. You cannot find MPV without discounting. So from year 0, you have a cash outflow of 100,000. Year 1, you have a cash inflow of 50,000. Year 2, 50,000. Year 3, 50,000. According to the question, it says 50,000 for the next 3 years. Now you have to come and discount these cash flows, right? In year 0, the discount factor will be 1. And I'm sure all of you know the formula for discounting. The formula for discounting is simply 1 over 1 plus r raised to the power n. 1 over brackets 1 plus r close brackets raised to the power n, where r is the discount factor or the interest rate and n is the number of years. Okay, so if you have, it means that if you do your discount factoring for year 0, the discount factor will be 1. For year 1, it will be 0.909. For year 2, it will be this. Year 3, it will be that. So you multiply your cash flow by your discount factor and you get your present value. You get your present value. When you add all these present values, you get your total present value. Your total present value. When you subtract your cost of investment from it, then you get your net present value. Your net present value is simply your total present value minus your cost of investment. In this question, there was a twist to, what do you call it? Exchange rates. Exchange rate. So that's something that must be taken into consideration. But we can certainly have a look at that. We can certainly have a look at that. But the first method, which is method 1, is something that I'm sure it's simpler, and you would want to, you'd want to use, I guess. So after you calculated your present value, see, for method 1, you just you get your spot rate, and that's it. You're good to go. You're good to go. You just multiply and boom. You're good to go. Because you have CDs, so you just multiply by the spot rate to get your Naira present value. But there's another method which is a bit more complicated, so I'm not sure if you'd, I'm not sure it's necessarily a good option, but something you can look into. And I wouldn't want to touch on it too much. I would want you to focus on method 1, which is quite simple, and you could go with that. So at this juncture, we'll be moving on to past questions. So just give me a second and I'll pull the past question. Is it not right now that way anyway? How does this time move fast like that? Let me pull the past question real quick. Last time we did 2019, right? Please give me feedback, I beg.
Yes, sir, I think so. 2019.
Okay, so we are going to do May 2020. It's a recent it's a recent one, but we are going to do it. I'm sure you guys will like it. Yeah, this is the one I helped the students with at that time. So let's rock and roll. So as usual, someone can read, then we analyze, then we yeah. Anyone like to read? Anyone likes to read? Anyone likes to read? Anyone likes to read?
Hello, sir.
Yes.
Okay, I'll read.
Okay.
The beginning, I think you should enlarge it a bit.
Sorry?
Please, can you enlarge it a bit for me? It looks very tiny.
Oh, okay. I see. Is it better?
You let me take it like that. But if you can expand it further, I will be grateful.
Your line is even breaking. It's even breaking, so I can't even hear you properly.
Please, I'm reading.
Okay, thank you.
The beginning of Customer Focused Limited. Customer Focused Limited was registered to begin trading on 1st January 2017. It opened a retail food store near one of the key malls in Accra with a promise to customers to provide low prices, great value, and high quality every day. The founding investors were 3 Ghanaians, Papo Ama, Akwesi Boateng, and Mary Aqua. The business owners are actively involved in the management of the store. The initial equal capital of the business was provided by them. Additional debt capital was also raised at the same time. A retail unit was rented near one of Accra's leading malls for an initial period of 5 years and provided sufficient retail space to offer a range of food products. Initially, the focus was mainly on selling packaged and processed food so that customers could buy food that was convenient to cook at a time when it suited the busy Ghanaian office worker. The business owners had previously worked for the food retail stores in managerial roles and knew much about food retailing. However, they had never considered what it meant to run a business in terms of attracting customers and dealing with the new commercial environment they faced. Can you scroll it up some more, please?
Okay.
Even though competition was tough, the business owners realized that store location was paramount to the business success, and in this, they had proved to be correct.
Okay. So thank you very much. So let me explain. Like I said, I'm trying to drill how to analyze cases into every one of you. It's not difficult. As you begin to do a lot more cases, there's one I put on the group, which we might look at later if we have some time. I'm not sure when the pre-scene material comes, but in case any one of you finds it or it comes and you sees it, just let me, in case I'm busy. But I'm trying to drill into your minds how this whole case study works. How this whole case study works. So it talks about the beginning of customer focus. The beginning of customer focus. It talks about the beginning of Customer Focus Limited. And that would give you an idea of, the path that this organization has been on. And like I said, you take each item or sentence very seriously. Very, very seriously. So Customer Focus Limited was registered to begin trading on 1st January 2017. So this is when they started trading. And it says it opened a retail food store near one of the key malls in Accra. So where should your mind go to? Where should your mind go to? Where should your mind go to? First of all, in the last case, it was around the tourism industry. This one, it's around the food industry or the retail industry. Sorry, I should have said the retail industry. So the dynamics are a bit different, but the principles are the same. So it says it's open the retail food store near one of the key malls. So what should be going into your mind? What should be going into your mind is location, 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 location. And when we talk about location, what comes into your mind? What comes into your mind should be the 4 P's, right? The 4 P's, which is the marketing mix, which is place. Place talks about location, So what are the implications of a location like this? It's near one of the key malls in Accra, so, it seems to be a good location. But one of the things is that this key mall in Accra, would probably have the customer base already, would probably have the people already. People would be more familiar with them. So it means that Customer Focus Limited has to do a lot more work in, attracting customers, because if it's a key mall, people will visit there already. So location here, you can look at it in terms of an advantage or a disadvantage. Yes, location seems good because it's in Accra where people are always visiting to buy stuff, but it's near one of the key malls, so there will be some form of competition. And the question we need to ask ourselves is Customer Focus Limited, ready enough to face competition from one of these, as the case puts it, key malls. Then it talks about their promise. Every organization should have a promise, or a strategy, a strategy. Their strategy they are saying is that they are going to offer low prices, great value, and high quality. Unlike the previous case we looked at, it was high prices, in great value, and high quality. This one is the reverse because, the industries are different, the strategies are different. This one, they are saying we will give low prices, great value, high quality. So you want to look at a promise like this. How is it possible to have a mix of high quality and low prices?